Welcome back to the Sell Ready podcast. Look, today we are joined by someone who's been in the trenches of tech, M&A, and company building over the last 3 decades. Nat Burgess has advised, brought, and sold over 100 companies across multiple waves, from the early internet era to SaaS, and now the AI revolution. He's worked directly with founders in one of the most critical moments in their journey, turning their company into something that's somebody actually wants to buy. And what's really interesting is that, Nat, you've seen this across multiple cycles. So this isn't just theory, this is pattern recognition. And right
It
now,
is. It
yeah,
is pattern recognition, but I think this AI pattern may be a little bit different.
really, yes, exactly. Like the rules are changing again. So what even made a company valuable a few years ago is not necessarily what gets deals done today, right?
Exactly.
So Nat, look, I'm really, really excited to have you here. I would love to get started. Just give us a quick overview of your background, what you're focused on at Tech Strat, and we'll just love to hear from you.
Yeah, great, Alyssa. I really appreciate you having me on as well. Just
Yeah.
the themes that you're thinking about these days are ones obviously we're thinking about every day. Helping emerging companies be relevant to buyers as the technology landscape changes and as AI changes everything. And so I'm looking forward to the conversation. So quick background, degree in Japanese literature, and didn't end up slinging fries at McDonald's. Not that there's anything wrong with that, but I went to Wall Street. I was at Morgan Stanley in New York and Tokyo working on cross-border deals. And that was late 80s. So before tech M&A was a thing, we were doing pharmaceuticals and manufacturing and traditional industry. But I came from a software background. I learned coding in high school. I learned machine code. I learned, early days with the Timex Sinclair and TRS-80s and early generation computers. So when I came back from Tokyo, I ended up getting a law degree, focused on IP work and IP issues, worked for the SEC in the first generation of stock offerings over the internet. We weren't actually doing the offerings. We were just figuring out how the regs would apply. And was involved in starting an early internet company in the 90s. But since about 1998, I've really focused on helping entrepreneurs sell their tech companies. And I've sold 6 to Microsoft. I've sold 3 to Intel. I've sold 3 to Google, and more recently done a lot of work with private equity. And I've also been an angel investor along the way. Although, as you can, if you're watching this on video, you'll note that I'm not in an office. I'm in a farmhouse. So a little bit of hands-on work today. Little break from AI, except for this wonderful conversation. And so about 30 investments over the years, sold one to Yahoo, sold one to Google. And I've had a few that washed out that I try not to think about. They don't all work out. But through that, as you referenced, Alyssa, there's been just generations of technology that have had to, entrepreneurs have had to change their strategies in order to stay relevant as the technology changes. And that's never been more true than today. And it applies both to strategies for how you identify a lane for a product and build it and build relevance. It also relates to how you run your own company and leverage AI to improve your operations. And frankly, also to get through due diligence, because these tools, man, they give you superpowers. And I've got some examples of some clients that have really shown what's possible in that regard. So anyway, we could spend 3 hours, and I'm really excited about the 30 minutes that we have.
Yeah. Well, no, thank you for that introduction. And like I really want to dive into this. You stated something that I thought was something that we should probably dig a little bit deeper into, about how the AI revolution is going to be quite different than the rest, right? I remember watching one of the podcasts that you've been on before, and you mentioned how you had a moment where you just knew the internet was going to be a thing. And so tell me a little bit more about like your experience getting into AI and how it's impacting the market, and why you believe it's just going to be so much different than the other cycles or waves in the past.
No, great question. And definitely the internet was a network, right? So we were thinking about software as a discrete blob that would run on a machine, and it would solve a discrete problem. So you had to understand the problem, and you had to be able to tell a machine how to find a solution. So then you add a network, and then suddenly you've got some shared intelligence across the network. You're able to deal with redundancy and backup. You got new cybersecurity threats. Everything changes, and you can no longer settle for just being a server. You got to be client server, then you got to be end tier, then you got to tie into the internet. And so we went through those changes, and we had ASP, and we had SaaS, and we had focus on data to prep for AI. Now we have AI. And I think this is a little, bear with me a little bit, because I'm going to use an analogy that may not seem obvious at first. But when Alaska became a state, they had to figure out how to manage the fishing industry. And they had 2 choices. They could put nets across the rivers and, close them, catch fish, open them, and manage it very efficiently with very few people. and catch all the fish we need while preserving the fishery. Or they could go to
Right.
the other extreme and issue permits for individuals to become fisher people and to have boats and to go out and run around. And that's what we chose to do. So we had hundreds of thousands of fish boats out there, gill netters, seiners, hand trollers, power trollers, draggers, trap boats, all earning a living, all individuals, captain of their own ships. And that's what our software industry has been so far, right? I mean, you would build out one 4GL platform like Progress Software, you'd have 2,000 different companies developing software on it. Then you have Microsoft Dynamics and
Right.
Google Cloud, and you have millions of companies all using that as the back end. But we have all these, basically, we've created an industry of hundreds of thousands of companies. And AI is the net across the river. Like everything
Mm.
changes. It takes the bulk of the work, it adds intelligence to the network, and it gives us sort of the superpowers. If we have access to the high level of data, the sort of meta level of data gives us superpowers, not us entrepreneurs, but the big platforms, the
Right.
guys we know and love. The chat GPTs, the
Yeah.
Googles and Microsofts. And so as entrepreneurs now, we've got to sort of acknowledge that, okay, we're kind of becoming ISVs or VARs because
Mhm.
we're going to have to buy tokens from the AI machines. And so we got to pick a lane where we can still create relevance with customers, where we have a moat, where we can defend our territory, and where we can actually create a company. And as with every technology disruption, the pie doesn't get bigger. The pie gets
Mhm.
smaller. And so we're
Right.
fighting for smaller. It'll probably cut the total revenue from the software industry in half over time. And so not only do we have to be a lot more careful and clever about picking a lane where we can make money, but we also have to acknowledge that it's a fight. And one result of that is a lot of the funds that we've dealt with, the private equity funds
Mhm.
that kind of went from traditional HVAC services or rolling up medical practices and so on.
Yeah.
They're out of software. They're back to their knitting. So, a lot of investors, a lot of people have sort of acknowledged this is harder. It's different. I'm out. Guys who are in it at the core, like a Thoma Bravo, for example, they're not going anywhere because they control a huge portion of the industry. But also, they're publicly saying, "Hey, all the software companies are on sale now. Go buy.
Right.
They're cheap," which isn't great for my clients, but it's how it
Right.
is.
Right. Yeah. And like speaking of, how do you like help better prepare your clients, or or what advice would you give a SMB SaaS company who, so they can be more worried about defensibility in a world where their business model, their base infrastructure is directly reliant and has a large
Mhm.
dependency on these large language models?
Yeah, that's exactly the issue. So the answer is start your company 10 years ago and build up a loyal customer base. I say that half facetiously, but in fact, most of our deals last year were not AI companies. We sold a lot of companies that had established a loyal customer base. We're solving
Mhm.
real problems, but we're frankly too small and undercapitalized to really turn up the heat with AI. And so they were acquired by companies that had those resources. And a
Mhm.
lot, and some examples: energy data company that tracks energy policy and moves across the entire nation, all 50 states, went to a bigger, better funded AI powered company that can do predictive analytics on energy prices throughout the country. We sold a competitive intelligence platform called Newsletter that was like Google Alerts on steroids, but you could track all your competitors and see everything they're doing,
Mhm.
and you get flags and you get notifications. But there was so much more they could do with more AI behind them. So we sold them to SimilarWeb, and now they have those resources and they're doing that. So anyway, that's part of the answer is when SaaS, previously known as ASP, kind of overthrew the traditional software industry, all these SaaS companies popped up and raised capital and built solutions, but they couldn't find customers for them. And I remember speaking at a SaaS conference in the late 90s, and it was called ASP, not SaaS, but these guys are like, "Hey man, we built a much better solution. But we can't find revenue." Well, that's somewhat true with the AI stuff today. So the folks who've already found a way to get the customer's attention and lock them in, that's the better mousetrap doesn't dislodge that customer. So I'd say the first thing, if you're really starting clean sheet of paper or early stage seed, maybe even Series A, is you're not focused on the better mousetrap. You're focused on capturing the customer's attention and loyalty and solving a problem for them in a sticky way where you're not going to be displaced by AI. You're going to be enabled by it. And so going back to my like nets across the river analogy, that doesn't solve the problem of matching the hand troller or the person who carefully processes fish for a specific restaurant in Seattle that's willing to pay top dollar. Doesn't solve the last mile transportation and cold transport problem. Doesn't solve the testing. Doesn't solve like some of the predictive analytics you might need to do around salmon runs and how to like decide how many to catch and how many to leave. So the focus narrows, and it narrows to very specific actionable customer problems, and you figure out how to solve those and you get revenue. And it's frustrating because everyone wants to go raise $10 million and have a $100 million company a year later. That's not going to
Right.
happen very often anymore. But the folks who really focus on listening to the customer, understanding what a specific problem is, and then solving that in a kind of efficient, invisible way, I think that's where the upside is going to be.
Yeah, understood, understood, and I think that kinda relates to something that we spoke about on our quick intro call. You mentioned that it was something that was really interesting to me. The best strategy isn't actually to become an AI company, and you kinda just leaned into that a little bit. Now, I wanna know why, like, where do you see founders really getting this wrong at right now? Is it just because they're not as narrow as you just suggested, and they're not really just going problem solution framework? Or, where I would love to hear your perspective on that.
Yeah, I've got an example that I want to be a little cautious because I'm an investor in the company and I helped get them going, but and they're doing all the right things right now. So we sell technology companies. That's our core focus, but we've also been involved in angel investing, and we actually incubated an AI startup within Tech Strat and spun it out, and it raised VC, and it's off to the races. So what happened with us was we saw how powerful the AI tools were for the basic work that we do. There's a reason
Mhm.
why Morgan Stanley just laid off 2,500 people. There's a reason why that whole analyst track on Wall Street that I learned so much from is going away. And that's because that grunt work that we used to do that we learned so much from is all being automated. So someday you'll visit your doctor and you'll say, I've got a pain in my whatever, and the doctor will have no idea what you're talking about. They'll just consult their robot. So
Right.
you'll go to a lawyer and they won't have gone through the paper chase and all the pain that we went through back in the day, but there'll be a bot that'll give you the answers. So anyway, what we saw was an opportunity to automate a lot of the creation of the baseline investment banking documents that we work with and the baseline research, peer
Mhm.
groups, precedent transactions, competitive analysis, who's announced similar products, how do we think about the buyer landscape, valuation
Yeah.
metrics, all that. And we were doing it with elaborate prompts, but we had a former client. We helped sell his company, really skilled in this stuff. And he brought in a CTO, and we created deliverables.ai, which was
Mm.
designed to build those out and do them. And it became a foot race between deliverables and ChatGPT. And I would log into ChatGPT every couple of weeks and just try some of our keywords, our sort of templates, our document formats, and gradually they would figure them all out and get ahead of us. And then we'd race in a slightly different direction, and they'd figure it out, get ahead of us. And so it became pretty clear that we weren't going to be sort of the overarching investment banking solution when so much of this can be delivered directly by the platforms. And so what Deliverables is doing now is really narrowing the focus to more of like a localized Claude code kind of persistent engine that can almost take over the back office operations of a practice like ours.
Right.
And I won't say too much about this, but there are some very specific compliance oriented requirements and documents in the industry that are too narrow for the chat GPTs of the world to really invest in. Because make no mistake, if chat GPT needs or Claude needs to learn a new domain, it's very expensive for them to go grind through all of the existing literature and data and figure
Yeah.
it out. It's very expensive. And that's why early days, you'd ask a question and they'd be like, nah, not
Yeah.
doing it. It's too hard. Not today.
Yeah.
I'm tired. I need a nap.
Yeah.
So, so that's an example of basically kind of starting with an overly broad vision, realizing we're trying to boil the ocean and chat GPT is turning up the heat faster than we are. And so then just
Right.
narrowing the focus.
No, understood, understood, and so until you narrow that focus, that kinda goes back into your marketing and your targeting. You can't really without if you are a smaller business and a smaller SaaS company, or even like you said, operating system more so is where you guys are positioning at for deliverables AI, you have to be very focused on a direct ICP. So then when you are in that in marketing, getting people in the door is a lot easier because you don't have those 10 years of experience and trust in the marketplace just yet with a new software company. So I love that approach. I love that approach. And I think I want to shift gears here a little bit. I know we have
Mhm.
only maybe about 10 minutes or so left. I want to think a little bit more about like buyer psychology. Like what are buyers actually looking for right now? And like most of the founders are really misunderstanding, completely ignoring. I would love to hear your perspective on that.
That's something it's not obvious from the financial press what's been happening, but private credit markets got really scary. BlackRock, the the big underwriters were basically re-underwriting everyone. And when I say everyone, I mean all these private equity roll-ups, all these software companies, SaaS companies with sort of 50 to 500 million in revenue. They all had big commercial lines, and those are all in question because of this sort of SaaS apocalypse or whatever they're calling it. So that's one element. So now, 2022, we're doing deals all day long with private equity, and $200 million deal, we'll borrow 60, we'll equitize it. It's great. Interest rates 4%, no problem. Here we go. Interest rates went up, and now lenders are pulling lines and revisiting lines. So debt becomes harder, and valuations go down, or sellers don't sell because the valuations are too low. That's one element. Second element is a lot of the private equity funds that built up portfolios over the last few years have been trying to sell them, as they do, right? They buy it, they build it, they buy 5 more companies, they roll them together, they got 100 million in revenue, they go sell it. They sell it up to a higher tier private equity fund, or they sell it to a strategic buyer, or and they take it public, but not really anymore. They're not able to sell them. And so then they circle back to us and say, hey, you sold us 2 companies into this roll up, and now we're taking it to market and we're getting no love. We need an AI story and a strategy. Can you help us buy an AI company till we can become relevant again? And that's, so I said earlier that maybe you don't want to go become a AI company and invest in that because you've got some heavy competition, but, asterisks, footnote, a lot of these companies can't shift gears and become AI first on their own. They've got to acquire the DNA. And one of the big inhibitors of transitioning to AI is the need to integrate with legacy software and systems. And so you can't just clean sheet of paper, build a better mousetrap. You got to keep all your existing customers up and running and happy. And so you're really handicapped in that regard, and your ability to just try new things and go race off in different directions. As a startup, you don't have those constraints. And if you could really orchestrate an AI first mentality within your company, then that's going to help a lot. And you might end up seeing a premium on a deal where you bring in that DNA and expertise to a buyer. We're actually seeing that a fair amount. And the other thing we're seeing is dev teams getting high graded based on who is eager to adopt and leverage those tools. So we have one client that had 10 people in R&D. They're about a $26 million revenue company, relatively small R&D staff. It'll be 5 by the end of the year, but it'll be 3 times as productive because the half of the team that embraced the tools and adopted this whole AI first kind of mentality is going to stay. Their productivity is skyrocketing already, and the rest will move on and find other things. So that's another element for sure, is curating your team to the extent you can, not necessarily for the most expensive talent, but for the talent that's willing to learn and lean in and really leverage the tools.
Right. And
let me just make, sorry, Alyssa, I want to make one more comment because I just, that AI first mentality, we've had a couple of CEOs who we got into a letter of intent stage and it was time to start diligence, and they got the checklist. And it's a worksheet with 5 tabs and 400 lines. And, 2 days later, they have a 90% response. And initially I was like, how the heck did you do that? And then later on, I was like, you're pretty good with these AI tools, aren't you? Just turn them loose in in all the systems. Have some, create personas, do some sort of checking along the way. And it can be really fast and efficient. Contract management as well. I hate to say this. We sold a company a couple of years ago that was a contract management solution. You dump all your contracts in a folder. It would give you the parties, sign date, expiration date, hot terms like exclusivity, change of control, assignment, whatever. And $50 million transaction. Well, we can do that pretty much over a weekend now with the tools we have. But if you're a smart company and you're embracing the tools, you could really be, you could be very professional in how quickly and thoroughly you respond to the diligence questions.
Yes. And so being an AI first company is something that so it's okay, have a good product, so regardless product, service, whatever, but make sure you have an AI infrastructure backing your business beyond the people is what I'm hearing.
Definitely AI infrastructure, but thoughtfully done, not a bunch of spaghetti code that people have used prompts to assemble. So you still need to be aware of security and cohesiveness and being able to advance your stack. But the answer is yes. So, seems like every B2B SaaS segment has very specific examples where, the old days of product and portfolio management or project and portfolio management, where you'd have a company like discrete resources, they'd figure out what projects are coming up. They'd say, okay, this team will work on this in October, and they'd map it all out and manage their resources. Well, it turns out if you're in that position in a company, all these questions are surfacing all the time that are really best addressed with AI, or at least best organized and managed and prioritized with AI. So having a position in the company and having visibility on what they're doing and what they need and where the pain is it gives you a chance to deploy these tools and really add value beyond what they were expecting.
100%. 100%. Well, it was one more thing I wanted to mention to you that really stuck out to me from watching many of your content online. It was one that you mentioned about the valuation. The valuation of a company is really what you can execute against and not really what you think it's worth, right? Well, why
Yeah.
do so many people think that, like, get that wrong? So many founders really get that wrong.
This is one of those rare occasions where you ask a tough question and I know the answer, but I'm not going to tell you. No, I'm kidding. But so when you're raising money, you're asking someone to give you $1 so you can turn it into $100. And that's a kind of pitch where you're saying, here's my TAM, here's how it's expanding, here's the white space I'm growing into. I got an early entry in the market. So we're going to grow whatever, 400% for the first 3 years, and it's going to be great. And the investor says, okay, that could work. I'll put $1 in. And if I
Mhm.
lose it, I've got $1 and 50 other things. So some of them are going to work out. I'll be fine. M&A is the exact opposite. You're not asking someone for $1 that you can maybe turn into $100. You're asking someone for $1,000 based on what you've already built. And
Mm,
that's not a venture valuation. Even with ARR multiples long term, it boils back down to EBITDA and profits. And so the financial proposition is different and the nature of the buyer is very different. VCs, they're optimists. They have to be in their business. I mean, it doesn't feel like it when they're turning you down, but the fact is they're rolling the dice on stuff every day. But if you're in corporate development at wherever, Google or even Palantir, you're judged on how well the deal worked out. Did it deliver on what was promised to us? And if not, go find a new job. So very sober, pragmatic, experienced, skeptical audience paying for 100% of the value of what's there, which is very different from putting $1 in and hoping it works out. I think that's the
right.
fundamental difference in mismatch. But then other elements that I see again and again, I think sellers undervalue what's already in place. So I'll give you an example. Years ago, I sold a business called Binary Research to Symantec, and they were a disk cloning tool and $3 million in revenue. Symantec turned it into a $100 million business in 18 months. But they didn't pay us for a $100 million business because they
Of
weren't
course.
willing to pay again for all the distribution that they'd paid $1 billion already to build out. So they get credit for the part they already have, and we get credit for what we bring to the table. And maybe we can share the synergies a little bit, but not a lot. But that just means it's a much more sober conversation than the capital raise conversation.
Makes a lot of sense. It makes a lot of sense, and I love that example that you gave as well because it really painted the picture of, okay, raising before you really have, proof of concept, market share, and even the ability to, get the widespread knowledge or of your product that these larger companies are going to be able to do, kind of sheds light on the buyer psychology and how they're going to
Hmm.
value your company regardless of the numbers. And so that's also
Yeah.
important to kind of keep in mind. So thank you for sharing that. The last 5 minutes
So,
of the podcast, we always like to do this segment that I call the operator stack. And we ask every founder, every operator this because we're actually building a data set on how top decision makers are thinking when it comes to building and scaling companies. So I like to I have my whole everything on my brain documented, and I document almost every one of my conversations. So this is part of that. We just like shoot it super fast. Nat, like I'm gonna go through a question. First thing that comes to mind is 5 questions, and then we wrap up the interview, and we'll be done for the day. So,
all
are you
right.
ready?
I think so. I have no idea what's coming, but okay.
It's pretty simple, it's pretty simple. My first question is, if you had to double the value of a company in 12 months, where would you focus first?
Retention, churn, customer loyalty, full stop. In
Retention,
other words,
churn, customer loyalty.
so diligence right now is all about that's great. You have a bunch of customers, but they're all going to leave next year.
Yeah,
If I can show that they stay with me and I can show engagement and use and customer loyalty, that's my biggest defense against the AI wave that's coming because AI can't take my customer unless my customer decides they don't want.
true. That's amazing. 2, what's the most common bottleneck you see consistently that prevents companies from scaling?
People are limited in their scalability as managers. There's a reason why Microsoft brought in a CEO with a different range of experience at every stage of their growth. And I can't name names because I've forgotten by now, but if you look back over the years, when they were just a bootstrap crazy startup, then Bill Gates was the right guy. But as they got bigger and they had to scale and think about systems and so on, they needed different talent. So again and again, we see like a founder who's really good at Gen 1 product, but not good at the big partnering and kind of scaling problems that come up next, or back office or financial governance, et cetera. They better partner with someone who's got those skills, or maybe even step into the chief software architect seat and let someone else run it. So it's people. People are the limiting factor most of the time.
Yes, and I love that because that ties directly into the next question on like when you're evaluating people or even leadership team, like what's one signal that you immediately tell someone's A plus talent and high caliber?
I want to see, so it's a good question. So someone who sold steak knives door to door in high school,
They have the grit and the
right?
grind.
In the grind, like not afraid to ask for the sale. Pay me. These are
Yeah.
really good steak knives. Show me the money. It sounds silly, but so much of technology has become this sort of ivory tower. This is so cool. Let's nerd out on how cool it is. Someone's got to go ask a customer for some money. And ideally, the CEO has that DNA. So that's one thing. Not literally steak knives in high school, but someone who's not afraid to be sales oriented and close the deal. And then the second is show me someone who's done something hard. I don't care if it's relevant or not, but if they're a beautiful violinist who plays with a community orchestra and has a history of making that instrument sing, that tells me that there's passion and diligence and determination there. And one example, but it could be across a lot of different fields. So I'm not necessarily looking at have they done exactly the job I need them to do. In fact, maybe I prefer they hadn't. But I'm looking for people who have been willing to confront, take on hard challenges and succeed. And then the third thing is I get pretty tired of hiring people who have a history of changing jobs every 2 years because surprise, 2 years later, they're gone.
Yeah, someone who has been consistent and has that grind, shows up every day and has a passion for whatever it is that they're passionate for in life, but it has some sort of passion that drives their story.
Passion.
Yeah,
Yeah.
I love it. I love it. Last two questions here, Nat. When you're making a high stakes decision, what's the first principle or framework that you rely on?
I always look ahead a couple years and I think, are we going to be sitting down and having a champagne toast and saying, I'm glad we did that? There's a lot of stuff that feels good in the moment. One of my favorite quotes is, I don't know who said it, but never make life-changing decisions while at sea. You know, you go for a sail on the weekend and you're like, this is great. I'm going to sell everything and sail around the world. Well, you might want to get off the boat and actually consider it a little bit. So yeah,
Yeah.
is this moving me towards is this satisfying an immediate pain? I'll feel better. I made a bargain. I developed this thing because a customer asked for it. Or am I actually thinking 2 years, I'm going to be future Nat will thank present Nat for making that decision because it moves my entire big picture strategy forward.
Yeah, I love that. Like, don't make a life-changing decision at sea or even in the rough waters. Like, when it gets hard, I think that's also the worst time to make a life-changing decision.
Hmm.
Stick through,
Yeah.
stick through the trenches, stick through when it gets hard, stick through the hard times. I agree. Um, and last question here. So, what's a mistake that you see founders repeat over and over again that costs them the most?
Since I work in technology, I see a lot of really talented developers and product makers, and I too often there's a sort of a barrier between the design of the product and the execution of building the product and what the customer is actually going to absorb and need. And so I want to see, I mean, I'm a big fan of the companies that get out and hustle. And maybe instead of raising the next little bit of money, they actually go out and find some customer money, like really be
Yeah,
100% focused on the customer. I think the AI change, and this is esoteric and I don't have any basis for it, but in the old days, you could envision a earth-shattering, game-changing technology and raise 20 or $30 million and build it and get acquired. Those opportunities are narrowing and narrowing. And so focusing on immediate, real, demonstrable customer benefit is absolutely critical.
yeah, I completely agree. And I come from a background of working with the developer, the product maker, and I'm usually the top of funnel sales, marketing, the relationship builder. And I think that partnership is so important. You need your Steve Jobs and your Steve Wozniaks. And I think some product makers don't put enough emphasis on the actual marketing of the product. So before you create, get people utilizing your amazing technology. That's the only way you're going to make money here.
It's so true. I mean, can you imagine like a CTO from 10 years ago when you tell them the customer is always right? Can you imagine them nodding and saying, yeah, let's change our product so it works better for the customer? No, people
Yeah.
get really wedded to their little walled garden. This is how it's supposed to work. Let's train the company to. train the customer to use it how I designed it. No,
No.
not how it works.
No, Nat, look, this was such an extremely valuable interview podcast. I really enjoyed talking to you. I really enjoyed, the insights that you had giving from the perspective of different errors. It's just great to kind of like hear from that perspective, especially, me, I'm 25. So like, getting to hear it from all the way before SaaS was named SaaS is super cool. And so look,
Yeah,
I
there's
think a
a
lot of
there's a silver lining to getting old, maybe.
maybe who knows? Like, hopefully I live long enough where we don't get old anymore. Who knows?
There you go.
Yeah,
No,
but I think a
I
lot of
appreciate
founders
you
are.
having me on, and frankly, the themes that you're talking about are so important and so critical. It's your generation that you're kind of helping to suss this out for, and I also really appreciate the prep, taking time to have a chat first and looking at some of the other stuff I've done online. That just shows that you're going to win. So thanks for having me on.
Thank you, thank you. Look, for anyone listening, we'll link everything below so you can check out what Nat's working on at Tech Strat. I appreciate you for coming on, Nat.
Thank you, Alyssa.